One of the great things about trading options is it's not like stocks where you only make money when the company goes up. How boring is that? What if I had multiple options? Like a call option.
Today we're talking options, where I teach you how to trade options, giving you a better option than the option that you previously had. That's buzz. Today we're talking about call options, specifically long calls and short calls. Now, long calls is one of the easiest option strategies to understand, and it's because it kind of looks like just buying outright with stocks. So a long call is basically in one contract, I own 100 shares of a particular company and underlying for a period of time. With options, you can use less money to gain or to own 100 shares for a period of time. Those 100 shares, if you were to buy it outright in Apple, for example, would cost you way more than you just doing it as far as in a long call position. So that's the reason why we like long calls, is because it gives us leverage for our money. So we know what long calls are, short calls. The reason why short calls can be very beneficial is because you can use a short call to hedge your positions. A short call is I'm saying that I'm bearish for a particular time. Now, I'm not buying outright in this case, I'm collecting money. But I'm only collecting a limited amount, and that amount is the max that I can make. I'm collecting premium up front, saying that I believe that a particular stock is going to go down, in this case with the short call. So what I want to do right now is I want to show you guys on the ThinkorSwim platform a short call and a long call and how we can use both of them with trading options.
Now let's jump on over into the long call. So if you're trading options, especially if you're using the ThinkorSwim platform, I'm going to have a video that breaks down the different elements, especially when you guys start paper trading, whether you're using ThinkorSwim or any other platform. You'll be able to understand this information and just apply it the same. So right here we have the two options contracts, which are call options, and we have put options. Right now, we're just going to focus on the left-hand side, which are call options. And you'll see two columns here that say the bid and the ask. So the bid represents sell. It represents our short positions, and the ask represents our long positions. So right now, talking about the long call, a long call, remember, it mirrors buying outright because you are buying those shares. The only difference is that it's only for a period of time. So you're buying those shares for a period of time, saying that you believe that this underlying is going to go up. So if we were looking to do a long call, we would look at the ask column, and we would look in the column that says calls. So right now we see CMG trading at $613. So what does that mean? That basically means that Chipotle, if you wanted to buy a share of it, it would cost you $613 for one share. Well, what if you wanted to buy 100 shares? That would then cost you $61,300. So the reason why that's important, especially taking into context why call options gives you more leverage, is because if you wanted to buy Chipotle, for example, but you wanted to do an options contract, remember an options contract equals 100 shares. So if you were to buy maybe a at the money long call, you'll see this right here. It says 1620. What does that mean? That means that if we were to purchase a contract, each share is going to cost us $16.20. Now there's 100 shares per contract, so all you have to do is multiply that. That means to buy one contract, a long call, it would cost us $1,600 and $1,620 basically. That is an amazing amount of leverage, especially when you talk about the fact that it would have cost you $61,000 just to buy shares outright with Chipotle, but you're able to take and kind of mimic that same position in the options world by simply doing options contracts. Now remember, an important component is the expiration date. So right here you'll see March 8th, 2019. These are your weeklies. Don't worry about that right now, but the numbers right here just shows you how many days until the last trading day. So we have one that's coming up right now with a 2-day expiration for March 8th, so that Friday that's coming up. But right now we're looking at 23-day expiration. So we have a little bit of time to see a movement in Chipotle. So that's how you would set up a long call position. And to walk you through it so you can see the entire process. You see, I just put it down to one contract, confirm send. And right here, what does this say? Your max loss is $1,620, $1,620. And that's because when you do long call positions, remember, whatever you buy, whatever you pay for it, that is the max that you can lose. And then you have here that your profit potential is infinite, meaning that you can potentially or theoretically make unlimited if Chipotle continued to go up for the next 24 days. So that's how you would do a long call position. So then now, jumping over to short calls, that is when you start to look at the bid column. And so right here, we see that it says 1490. So you may be wondering, why are these numbers different? So what we call this is the bid-ask spread. And it's really important when doing options trading, because what we look for is a tight bid-ask spread, because that represents the fact that the market is liquid, it's flowing. That's what we want, especially because when we're paying for something, we want to know, am I able to get out of that trade quickly? Am I able to get out fast? That's represented with how tight the bid ask is. That also represents how much you have to pay to get out of the trade. So just keep that in mind for now. But when looking at the short call, we see that it's at 1490 right now. So what that means with short call positions, remember, you're not buying in this case, you're collecting premium. So when it says 1490, I am going to collect $14.90 per each share in that contract when I do a short call position. So if we multiply that by 100, that just specifically means that for one contract, if we're doing a short call position, we're going to collect $1,490. So an important thing to remember with short calls is that is the max that we can make, the 1490. Remember, that is our premium. That's how we get paid to trade. So that's why we like to do our short positions, because we also have a higher probability of being correct with that trade, and we don't always have to worry about direction. But the opposite side is that we can lose unlimited. So when you step over here, you're gonna see that infinite word, especially right beside max loss. And I know a lot of traders, they see that and they freak out, especially beginners, because they're like, whoa, why would I ever want to take that sort of risk? I thought you said options weren't risky, Samantha. This is what you call a naked short call, and it is extremely risky. I'm not taking anything away from it, but you don't have to do a naked short call. The great thing about options is that you can cover your positions by adding other legs with either call options or put options. So now we know we have a long call and we have a short call. Two of the building blocks to trading options.
So the video after this is going to be about put options. So make sure you're liking and subscribing, because you know we're going to teach you how to trade in the shade in the county of Dade. 305, what's up? Especially on how you can hedge your positions, you Forex traders, you future traders out there, when you're trading options and when you're trading stocks as well.
If you have any questions or if you have any trade ideas on how you could use a long call or short call, make sure to comment below. Make sure to stick with Talkin Options. Until next time, peace.